as fractional ownership is not a mortgage. So there's no interest rate because there's no loan balance to pay off. The way the product works and the way the structure works is that the customer builds equity, and at the same time, they're renting the equity or the bricks that they haven't bought. And that rent is really market rate rent. So what we do is we benchmark against single family home rental rates, rental yields in the triangle in the market that we're in. And we look at those rates and we say, where's the rental yield for a single family home of equivalent build, structure, location, et cetera? Can we benchmark against that? And then we fix the yield for 5 years. And that's one of the big benefits to the consumers.
Hey, everybody, it's Matt Fowler at DoorifyMLS.com, the former Triangle, get to say that now, with our buddy Frank from Ownify. Hey, Frank.
Hey, Matt, how are you?
Really great. Thanks for joining us today on the latest edition of the Doorify MLS podcast. We've been doing these for about a year now, and I think we were just saying before that we went on that you were one of the first ones. It's almost been a year since we've talked. It's amazing.
Yeah. Well, first of all, congratulations on the new branding. As Ownify, I can appreciate Doorify, right? Really love it. So good job.
Yeah. You said we're cousins now. I think that's exactly accurate. We'll spend just a second talking about that brand. We hired agency McKenna from Chicago, who's a well-known creative agency in our space. And we have stretched Triangle as far as we can stretch it. We're 16 counties now, and Triangle, of course, is a small part of 2 counties. We're very proud to be associated with and located in the Triangle. We go all the way to Alamance and down to Smithfield, and we felt it needed to be expanded. We're also changing our focus a bit to think more about consumers. We see ourselves as a B to B to C business. So we've always kind of thought of MLS as B2B or business to business. But, a microsecond after we deliver that data element to the broker, he's sending it right on to a consumer. So ignoring the last part is kind of forgetting about that last mile. So we think a lot about consumers, which is really what drew us to Ownify, because, home ownership is in our mission statement, and building transparency, building bridges for people to find ways to become homeowners. We see Fractional as another one of those. And I know the space is evolving and Ownify has evolved. And I want to, maybe we could start with what's changed since we talked last year. With how are things at Ownify?
So Ownify is doing great. We've grown since last year. And since we spoke, I guess kind of 3 things, right? There's the consumer side of the business for us. There's the agent side of the business. And then there's the investor side. And the investor side has changed a lot. The agent side has changed a fair amount, and the consumer side really stayed the same. So let me maybe just recap and start with the consumer side, and then we'll dive into what's changed on the agent side and the investor side in particular. But on the consumer side, the mission stayed the same, and which is helping first-time home buyers buy their first home, right? Or non-owners, renters, turning them into buyers as an alternative to the mortgage. So the Ownify offering has largely remained the same, right? It's an all-cash offer on behalf of first-time buyers. They come in with a 2% down payment. So it's a low down payment hurdle. Today, monthly payments are lower than the equivalent for a mortgage. And we provide this on-ramp for customers to pick a home off the MLS, single family homes between 250 to 750, kind of the classic starter home. And we get them into the home and, enable the agent to make an all cash offer. And then the customer has this 5-year program that they're part of that is, I'd say, rent to own evolved with true ownership. And I would be happy to double click on that and what that means. But, this platform of fractional ownership, we've stuck to that and evolved it and, gotten the counties and local realtors and local closing attorneys, right, in the Triangle in particular, comfortable with that. And so that's gone well. We're, as last year, obviously live in the Triangle, the rest of North Carolina, done deals that go a little bit beyond that. And we just launched Nashville as the next market. So on the consumer side, that's obviously interesting. And so really, if you think about it, the challenge for first-time buyers has gotten probably worse from last year, right? In that home prices continue to go up. In the Triangle, we continue to see this 4 to 5% annualized appreciation. There's obviously not enough supply. I think everyone knows that, right? People are locked in, sellers are locked in. Hopefully that'll get a little bit better with interest rates coming down or having come down now a little bit.
It's gotten a little better in the Triangle just recently. Our total actives are over 10,000 for the first time in a while.
Yeah. So we're seeing a little bit of that. But I think we're far away from where it becomes easier for the first time buyer in particular, right? There's also a fair amount of pent up demand sitting on the sidelines. And we see this kind of in our, in our pipeline and wait list where people have come in and said, I'm really interested in buying a house, maybe not now, but 6-9 months from now, right? When the market is a little bit more maybe in balance. So the problem hasn't gone away. And I'd say for the first time buyer, the problem has gotten worse. That's, in a sense, it's good for us, right? It's hard for the consumer, but that's the problem that we're focused on. That's the solution we're providing out in the market. Really, a lot of the work we've done over the last year has been focused on the investor and the agent side of the business. So on the one hand, we have consumers coming in, qualified first-time home buyers with the low down payment, and largely, I would call them middle income, missing middle buyers, right? So folks with decent income, but not high income. And then what we've done on the agent side is really focus on two things. One, helping the agent community be better at marketing what Ownify does, right? Because it is a new offering. It is different than rent to own. It's different than a mortgage. So education is a big component. And we've built an agent portal that now has educational materials, tests, videos, collateral that you can download. We've built functionality that allows an agent to basically pick a property that they're listing. So if you're a listing agent, you can go to ownify.com, pick the property that you're listing, and create a flyer that outlines the program, the down payment requirement. Let's say you're listing a $400,000 home, right? 2% down payment is $8,000, and the monthly payment that gets created, and it displays your logo, your NC rec number, and you can use that for marketing. And so that's an automated process that we've built. We've built the ability for agents to come in and evaluate any given property on the MLS. That's integration, with you guys, with Doorify, to say, is this property eligible for the Ownify program? And so agents can really come back to their customers, their buyers, or to some extent their sellers as well now, and say, I have this program that is another tool in my toolkit that helps me either sell the home that I'm listing or, help you as a buyer get into a house with an alternative to the traditional
So,
mortgage.
Frank, since we have these subscribers as our audience here, let me jump in with two kind of process questions.
Yeah.
That integration you were talking about to determine the eligibility of the specific listing, we've had an issue in the past where there were certain developments that didn't allow or were deed restricted against fractional ownership, or I think it was a short-term rental. And there were properties that were, I guess, a broader way to put that is legally eligible. How are you screening the properties and how do you determine eligibility?
The first thing, I guess, is, we're largely focused today on single family homes. If a single family home is in a development that has an HOA and CC&Rs that might be restrictive, we obviously review those. Generally, because our program is really designed as an on-ramp for first-time buyers, we basically create a 5-year commitment and a 5-year fractional ownership structure. And because it's long-term, right, most of the HOAs or most of the communities that have restrictions against short-term rentals in particular, which were really designed around the Airbnb idea, we don't have an issue with that, or they don't have an issue with the structure that we're using. You're
going to evaluate these kind of independently, having to look at the HOA regs or whatever, but Ownify is going through that.
We do that background work. And, so far we haven't run into any problems. We have one customer who lives in a community and the HOA said, you can't have a pool pass because you're not on the title. And the answer is, well, there's an LLC that's on the title and I'm a member in that LLC, right? So I'm holding title through an LLC, like something like 2 million other Americans do.
Sure.
And so once you explain that to the HOA, they're okay with it, right? And that family got their pool pass.
But that probably answers my other questions. So it's an LLC structured over this kind of fixed term that is just getting people an on-ramp into this house.
Correct. And if you think about it, what does fractional ownership mean? It means that you're buying a fraction of the home, a fraction of the equity, right? And what we've structured is a program where the customer starts with 2%, that's their down payment, and they work their way up to 10%. So at the end of 5 years, they own 10%, and that's enough for, the traditional mortgage down payment. And so how do you express ownership? That was a hard part to really think through. Today in the US, you can't fractionalize a title. It's very hard to do that, right? You can do TIC and some other structures. But what we can do and what we have done is we put the title into an LLC. So a limited liability company holds title to the home. And that LLC issues 10,000 shares, or bricks as we call them. And the customer on day one buys 200, and then every month they buy more, right? And that's a bona fide membership interest, a bona fide ownership stake in that home through the LLC. And every county, most counties in the US have seen that structure, have seen an LLC hold title to the home. right? And then what you do with the membership interests within that LLC really don't concern the kind of real estate side, right, of the county or the state. That's a separate transaction. And that's how we enable that ownership transfer to the ONI, to the customer, to say, start with 2%, build up to 10%. And once you have 10%, you can buy the rest of the LLC, or the rest, you can buy the home from the LLC, kind of the traditional way. And so, that structure, I think, works, and closing attorneys and the folks that you work with through the transaction and realtors have understood it pretty well.
So I guess 2 questions here, Frank, about working with the realtors. They just had this big change on August 17th, removing compensation from the MLS environment. We did that at Doorify on August 6th, just to get a little ahead of the day.
I know my data was gone on the 6th. I saw that, Matt.
Yeah. Well, that's a lawyer. Like, ask my lawyer at doorifymls.com is probably an email address I should have, and I'll just send all related questions to those guys. Yeah. I'm a tech person and really trying not to give legal advice. But when that happened, of course, the buyer representatives that do a very valuable service, I think buyers should be represented. Tell us how Ownify fits in that kind of conversation ideally.
Yeah. So first of all, I agree with you, right? We use agents as the number one acquisition channel, and we've built, as I mentioned, a big part of our business around the agent accreditation, the agent process. We built this agent portal. So as part of that, obviously when the NAR settlement kind of came down the pike starting in March or even before, we looked at this and said, well, how do we want to position ourselves going forward? And legally, the LLC that we create is the buyer. So we have a buyer's representation agreement with the agent. And in fact, what we do is we do a 3-party agreement, right? So an agent who might have a customer who wants to be an Ownify customer, who wants to buy a home with Ownify, ultimately becomes part of that agreement, where we are part of the buyer's representation agreement. And the LLC technically pays the commission, right, out of the closing proceeds. So when the settlement came about, we looked at this and said, well, what's the impact, right? And I think that's a question that no one has a good answer to. I think we're still going to learn, right, over the next couple of months and years how this is going to shake out. But one of the things I did, obviously being a member of the MLS, right, Doorify, is great in that you can analyze data. So we did a deep dive into what happened to commission data just in the triangle from March through the end of June, right? And then when I mentioned in August, the data went away because that field of buyer commission paid eventually, obviously, as part of the settlement, was taken off the MLS. But what we saw was that pretty quickly after the announcement in March, you saw a compression of buyer commissions, right? And the triangle historically has been somewhere around 2.4%. That's been the long run average. It's come down to 2.3 and then 2.25 pretty quickly. And so we said, okay, that's consistent with the thesis that a lot of folks have, which is, some sellers will try to save on the commission. If buyers have to negotiate it and pay it out of their own pocket, they're going to get, they're going to focus on it. They're going to negotiate it, but buyer's commission is going to get squeezed. And I think that's a general probably expectation, right? That being said, buyer's agent provide a valuable part of the work through the funnel, right? In terms of acquisition, finding the home, managing the process, all that. And so what we decided to do is we came out with a commission plan, and we call it the 2+10. And the way that commission plan works, and again, we're technically, legally, we're the buyer, so we can do that. And what we're doing is we're saying you will always get at least 2% base commission. If the seller offers something more outside of the MLS, right, per current agreements, right, and that can happen. Let's say the seller offers 2.4, great, we will pay you 2.4. Right. So it's at minimum 2 or whatever the seller is offering if it's more than 2. So that creates a floor at 2%. But it's 2% of the list price, not the close price, list price, right? And then we said, in addition, we're paying 10% of whatever benefit you as the agent negotiate on behalf of the buyer. Because part of the thing, and this is what personally always struck me as quite frankly, misalignment on the buyer's commission was, the agent who represents the buyer should do better when the buyer does better. That's the perfect alignment of principal agent incentive structure, right? Is if I drive a better deal for my buyer and I save them $20,000, right? I should do better. But historically, that $20,000 in savings actually knocked down the commission of the buyer's agent. So what we decided to do is that with this 2+10 is we said, you get 2% of the listing commission, that's your base. And then you get 10% of whatever benefit you negotiate on behalf of the buyer. So let's say you are representing a buyer and we buy a house and it's listed at $400,000, right? You 2% of $400,000, that's $8,000. That's your base commission. But then let's say you negotiate that price down to $380,000. Some of it might be seller concessions, lowering purchase price, what have you, right? So the net purchase price at the end of the day is $380,000. Well, that's a $20,000 benefit to the buyer, right? which is us and the customer in this LLC together as a fractional ownership. And so of that 20,000 in savings, we'll pay $2,000 to the buying agent, right? So you lowered the purchase price, but your commission went up. And that is a new structure, right? That's not out there as far as I know.
Right. No, that's really novel, Frank. And I love the way the incentives are aligned. Thomas Friedman in the book Freakonomics famously talked about the misalignment of realtor incentives with the seller. That's really novel. I love having a multiple fractional companies out in our market. We work with 3 or 4, and they're different things. I mean, it's not apples and apples, right? So, and your policies are different. I love that one of our subscribers might be able to look at, the information that we've put out on our podcast and see other models, like people, you were referring to one before we started the call that specializes in vacation properties. So, from a Doorify subscriber standpoint, these are things that you need to know about. When you meet a buyer who's interested in a particular property, you've got new ways of getting them into that house. You've got new ways of getting paid, new ways of exposing your value to them and getting paid for how well you do at that. I think that's really fascinating.
Yeah. No, I think that so far the feedback from our agent community, our accredited agents and folks we talk to, right? When I walk in as Ownify or Stephen Norris, our local partner walks in and does the kind of training overview, the feedback is always great, especially on the commission plan, right? And so just on the commission plan, I want to make the one last point and then we can move on.
Yeah.
So we have the 2+10, right, for the transaction itself. And then we've also built a referral program where we said to agents, if you recruit other agents to bring customers to Ownify who close deals, you will get 20% of their commission, right, as effectively a referral commission. Wow. And so we've had folks now starting to bring in other agents, whether, in their brokerages, in their teams, elsewhere, right, as referral agents. And that's really increased the growth of the accredited agent community and ultimately, brings us more customers. Or alternatively, we have more folks that we can send direct to consumer customers who come directly to Ownify back to as leads.
I think on our way out here, I want to ask you one more question, thinking about the agents again. I know looking at 25, we all want to make more money than we did in 2024. That was pretty rough. You said something earlier about rates. Tell me how that works if it's not a mortgage and in a rate environment where our partnership with the University of North Carolina on a previous podcast, we had 6 economics and housing professors looking at, reading the tea leaves and the rates. We're expecting a little more cooling, maybe a point between now and, end of next year or a little farther, but probably not more than that. How does Ownify fit into that?
Yeah. So look, I spent 15 years in my prior company in the bowels of mortgage math, right? We built the pricing engine for a lot of the mortgage lenders. And I think what we saw in 2020, 2021, 2022 was an aberration, right? The rates in the 2s and 3s are not going to come back anytime soon.
Hopefully not. Right. Hopefully not. If they do, something horrible's happened.
Well, then something else is wrong with the economy, right? And so I think where we will be very consistent with what you just mentioned, right, is rates in the mid-5s, and that's the long run average. If you look at 40-year kind of average mortgage rates, right? So that means that affordabilities continue to be squeezed, not as bad as it was maybe when rates were in the 7s, right, or high 6s. Ownify as fractional ownership is not a mortgage, right? So there's no interest rate because there's no loan balance to pay off. The way the product works and the way the structure works is that the customer builds equity, and at the same time, they're renting the equity or the bricks that they haven't bought. And that rent is really market rate rent. So what we do is we benchmark against single family home rental rates, rental yields, right, in the triangle, in the market that we're in. And we look at those rates and we say, where's the rental yield for a single family home of equivalent build, structure, location, et cetera? Can we benchmark against that? And then we fix the yield for 5 years. And that's one of the big benefits to the consumer is to say, rents normally increase, right? And landlords increase rents every year if they can. One of the things that consumers have told us, right, early on is absolutely we need fixed payment and we want fixed payment. And so we fix the rate, or we fix the dollar amount, right, the payment for 5 years. And so we benchmark against market rental rates, and then we fix it for 5 years. And that's the rate, the implicit kind of rental yield, right, which is the closest equivalent to an interest rate that you might see otherwise. Now, all that being said, when you look today at the all-in payment, we're a little lower than where current mortgage rates are. So right now, it's a really good deal for the consumer to use Ownify because it's a lower down payment, it's a lower monthly payment. As mortgage rates come down, let's say another 100 bips or so, we might be a little higher on a monthly payment basis. And the real benefit then is the low down payment, right? And the fact that you get started with 2%.
Well, that's really fascinating because I think rates are going to be pretty inelastic on the downside.
One of the big things we've changed is the funding model. And so we've launched a fund called the Ownify Home Fund, which is now open and growing quite nicely with investors coming in. So that's been local real estate investors nationally, impact investors. We've had folks come in with their donor advised funds to basically fund the purchase of these homes over a 5-year hold period with a target 15% return. So there's an offering now for the other, in a sense, the other generation and the other side of the economic spectrum, right? Folks who have disposable capital or capital that they want to invest in the long term in a safe asset class. And what the fund does is it allows investors to basically invest in residential equity, right, in the triangle and beyond, while helping first-time home buyers in that journey to home ownership. So there's an impact component, a double bottom line component, and then obviously solid returns as well.
That's 15%. Is that annual?
That's annual 15%. Yeah, it's a combination of, the rental yield, which is a couple of points, and then home price appreciation, right? So it's not, obviously 15% is not all paid out. That's the target over that 5-year hold period. And so as a financial structure, if you think about it, it's more attractive than investing in a mortgage REIT, which is the closest equivalent that you could possibly have, right? And we think that kind of funding model from investors on the one side and the consumer value prop, low down payment cash offer, right? Attractive monthly payment. That's really what's going to allow us to grow.
Well, that's super interesting, Frank. And we're trying to figure out that triangle where we're going to integrate with the fractional companies. We would like to have these options to be more visible.
Yeah, I think
educate our people to tell them about these other options, Acre and the other guys that just have slightly different models.
Yeah,
It might be something that's perfect for a particular buyer in whatever case that might be. And it's our role. We think of ourselves as sort of Switzerland in the middle, right? Like we're here to make them all work.
Yeah. Well, as a German, I appreciate that.
Yeah, exactly. It's all peace here at Doorify.
Yeah.
Well, Frank, thanks for spending the time with us today. And I hope some of our subscribers will look at the link that we put into the podcast notes about Ownify and can look into how that works.
Exactly. Come check out the 2+10. And if anyone has any questions, obviously Frank at Ownify, please reach out directly to me as well.
Thanks, Frank. We'll see you next week.